with Freddie, it'd be great if you could introduce yourself a bit, talk about the work that you're doing and how that's working with founders.
Sure. So I work for a VC fund based in London called Smedvig Capital. We invest in tech and tech-enabled businesses in the UK and Nordics at Series A and B. So we're typically investing between 2 and 15 million. There are 6 of us in the investment team. My title is I'm an associate in that team, which basically means I'm one of the kind of more junior people in the team. And I'm basically responsible for sourcing new investments and then due diligence on the companies. So we've been going for 26 years. Worked with kind of in sort of over 50 companies over that time period. And yeah, that's what we do. That's what I do.
Cool. Thank you. Ryan, do you want to quickly introduce yourself?
Yep. So. Ryan Sorby, I'm a principal at Boost & Co. Our Manchester office. We have offices in Bristol, Cambridge, and in London. We are a direct lender focused on the UK SME market. So we essentially provide debt to fast-growing businesses. They're typically young in their life cycle, and we will come in, I suppose, as a lender in theory at an earlier stage and at a higher amount than what traditional lenders and certainly, mainstream bank lenders would do. Biggest benefit, I guess, to borrowers would be that because of that early stage that we can come in with a debt offering, we can avoid dilution to those, to those management teams, to those shareholders. And that's a clear kind of, benefit of our solutions. Our check sizes are between 2 and 10 million, but we do have a kind of branching of those facilities, so you could draw down a smaller amount day one. Focus on tech. Those businesses with recurring revenue streams, recurring as a service model really suit our product. It's a term loan essentially, quite simple in structure. Can be provided for a multitude of uses as well. Working capital, M&A, shareholder de-risking, single asset purchasing is quite flexible in that respect. So that's Boost.
Cool. And I guess let's get the big question out of the way straight away. In the current climate, is there still money? Is money flowing? Should people just give up looking for money? Who wants to go first?
I mean, I'll go. And the answer to that is no, not at all. I don't think. This feels a really strange time for everybody. You might have got the odd advisor telling you that everything's going to be okay quickly and, we should just crack on as normal. That's not going to happen. We're going to be realistic about things. Things are going to feel smaller. That's going to feel slower. But I had a conversation yesterday with a deal that we had credit approval for 2 or 3 weeks ago, maybe 4 weeks ago. And we're looking at ways how we can knock the, the key points of our diligence exercise off as we work through that. So they're going to feel slow, but absolutely, this is something that we as an organisation, and I think we all generally agree that it's not a permanent change to the environment. This feels like it's going to be around for a while, but when we look back at it, it will maybe be a few months, maybe a little bit longer. We don't know, but it is going to be a relatively short period of time, and therefore, certainly, I wouldn't be suggesting, putting a hold on things. I'd be suggesting, keep close to those people that you're engaged with, your advisors, your potential lenders out there. Keep them engaged with what you're doing to manage your business, but the wider, the wider supply chains and your wider stakeholders during this scenario. Because how you react to these kind of events can give a funder and a lender a real good insight into the strength of the management team and how they react in these situations. So that'd be my advice.
Cool.
Yeah, I think, just the only thing I think it will vary a lot by funds. And our stance is basically we are pausing new deals for at least to the end of this month when we'll think about things again, because we're all our focus is on helping our portfolio companies at the moment. We've got 14 companies in our portfolio. and we're doing a lot of kind of analysis and work and bits and pieces helping them. But that isn't true for all funds. I do know of funds who are still investing even now this month. Like there have been deals in the last few weeks. So there will be funds which are still investing, but it will be there will be a big reduction for sure. The only other thing that I would add is that venture capital funds in Europe are sitting on record levels of what kind of we call dry powder, but basically just off capital. So whilst 2020 will undoubtedly be fewer venture capital deals than 2019, I would imagine, if this lasts for a few kind of months. But it may still actually be more than, I don't know, 5-10 years ago because of the record levels of capital. So, yeah, that's just sort of a caveat I would put on that.
And I would say it's interesting. So in terms of Bristol specifically, 5 years ago, there was about £40 million invested in the city into startups. In 2019, that figure was 400 million. It's still over 150 million for 2020. It has, unsurprisingly, completely dropped off in the last couple of weeks, but it's still at a significantly higher level than it was even 2 or 3 years ago when it was a good year. So whilst it has completely dropped off, we are still expecting quite a lot of money to come through. So thinking about the money that is there, where do you think people should be putting their focus at the moment, especially if they're thinking in the short term? Are there options to think about debt and grant funding whilst they wait out, certainly equity funding? Are there things that they should be prioritising around that?
Sure. I think it's kind of different. I think it's different for everybody. It's different in every scenario. If you look at somebody considering, am I ready to take on debt, or am I looking at an equity kind of round? That's not necessarily black and white in terms of looking at the data and say this is the answer. In the current climate, you might look at somebody with a number of shareholders that may be finding it actually easier to access growth capital at the moment because it's going to be quicker than a lender. Lenders look for lots of certainties. They've got processes to go through. They've got, financial analysis that they'll look at historic information and trends, and they'll pull out the certainties that they can kind of put a base case model together and sensitize and say, yeah, we're comfortable that we're going to get repaid. That's because those certainties are not around at the moment, or there are fewer of them. That's why things are going to be moving slower. Now, if you've got an equity, an investor base that knows your business, that knows a management team that's confident around the growth of this business beyond COVID, that should be a quicker source of capital to keep the business moving and growing during that time. So that's just one kind of example of why equity might be a bit higher up on people's agenda now, in terms of actually, if we'd got that access, we could have been moving still now. That said, as I say, different for everybody. If you've got to a point where you've scaled your business, you've gone through high net worth, Series A, whatever that might be, and you are really looking to just scale and really do more of the same, I can see why that can be pretty galling for a management team, Michelle, the basis say we're going to have to dilute further. And that's where boosts really like to come in, where we've proven the business model, we just need to scale and we don't want to dilute. Let's look at something where we can maybe prove that we can service debt in a short space of time, maybe 3 months, 6 months, 9 months. And we can avoid dilution by taking on a sensible amount of debt at this stage. So different for everybody, I think, but well worth considering all the options with your team and your advisors at this stage.
Yeah. And Freddie, if you're out of your current portfolio, because I know you have a selection of different businesses, are some of those looking across both equity and grant capital and looking at where they can bring forward grant money at the moment?
So in terms of the new grants that as part of like the new government actions post-COVID, I don't think there's any that are going to receive any of that stuff. Most of that grant funding is basically aimed, I believe, at essentially retail, hospitality and leisure businesses, as well as some kind of very small businesses which were previously not paying business rates. So they aren't really trying to get that kind of source of capital. Some of them are considering loans as part of the new kind of that business interruption loan scheme.
Yeah.
I'm not sure how that will pan out. I think one of the issues with that is in order to be kind of eligible for those loans, you essentially need to be in a position where you could have got a loan prior to COVID. So it doesn't really I'm not sure how much it will kind of really change. But we're in a lucky position where we're kind of essentially an evergreen fund. So we are in a position to want to support all our portfolio with further capital during this period, and that usually makes or can often make better kind of economic sense than loans, basically. So yeah, and we're in a lucky position that we can do that.
Yeah,
I think that something that cropped up earlier on in this week, which I think is quite useful and something to consider. I think the loan schemes and the the incentive schemes or the support schemes that the government has announced, I think there's a realization that maybe they need to get out quicker, and I think that maybe there's a slightly tweaks in criteria and other noise around how we get to deploy this capital quicker. One conversation I had earlier this week was around what that might look like post-COVID, and say you rightly looking at all your options as a business to say, how can I might not need cash now, I might not need cash in 3 or 6 months, but what if this carries on, and how can I put these plan B, C and D in place just to rightly manage the business. A lot of these government loans, they will come with kind of a requirement for a first ranking charge over security, and bearing all those things in mind in terms of managing the point in time when you put these instruments in place is quite important, because say you were going through a fundraise or you were going through a debt raise and these C-bills loans, that might impact the conversations that when you do go back to your lender in 3 months or 6 months time and say, okay, I'm carrying X amount more debt, and actually I've given away a first ranking debenture to the bank that's provided me with this, but I don't actually need it. I only might need it in 6 or 9 months time. It's all those little considerations that I think we need to be aware of and think about, as a longer term view, a longer term kind of consideration as structuring the right, getting the right capital structure right to deliver the growth and deliver the business plan. Yeah.
And I think in terms of sort of government support and some of the things they're doing, certainly civils, there's been a fair amount of criticism that's growing on a daily basis of how that's working and how quickly that's being deployed. Some of the other things they are doing, though, that are starting to have an impact are things like looking around R&D tax credits and whether the R&D tax credit payments can be made quicker, what that looks like, whether some of the Innovate-specific grants can be made quicker. I know certainly locally some of the activity that's being driven through different funds but run by the universities has started paying out in advance, all in the hope that they're things that support companies' immediate cash flow. So there are some things that are happening. Obviously, that's taking quite a long time to filter through. Certainly the small grants that you mentioned, Freddie, I had a conversation yesterday with Bristol City Council. They have pushed out some, so they've pushed out several hundred now, 20 odd million pounds, but they expect that there's going to be over 8,000 of those grants that they need to deploy in the next, and they want to try and deploy them in the next fortnight. There's normally 6 people who work in that entire team, so 6 people to try and deploy almost 8,000 grants in the space of a fortnight is a real challenge. So there are, I'm not one necessarily normally for defending the government and what the governments are doing to help, but there are a whole set of extraordinary challenges for them, and I know they are trying to do things. To your question, Gordon, specifically about state aid, I don't know if it's happened yet or whether I've just been told this. There's a whole set of things about whether de minimis funding, which normally means you can't have more than 250 grand worth of grants, is apparently being relaxed across Europe to 500,000. So that will start to affect what grants are available. And certainly who can apply for them and what that looks like. But again, that will take time, I think. So if we move on from the immediate, because I'm really conscious we spend all of our time talking about what happens in the next 3 weeks when that's not actually what people need. Can we talk a bit about, from both of you guys, how, obviously it's an extraordinary situation, but normally how long would it take to secure finance? How long should people be thinking about things and building that stuff up? So when should you be starting to look for that finance? Because something that we see regularly with our founders is unrealistic understanding of how long it takes to actually raise finance and how they can go through that, whether that is debt or equity.
So, I mean, it varies a lot by type of finance and stage of company. But for us, it basically takes about 4 to 6 weeks from the initial meeting the founder and team, to a term sheet. Somewhere between 4 to 6 weeks, can be, I guess, up to 8 potentially. Following that, we would do about 4 weeks of due diligence. So you're talking somewhere between 8 and 12 weeks, kind of from the start to cash in bank. That does depend enormously by stage, and I believe that kind of seed funding, things can happen a lot quicker. But I would say for Series A, B, you need to aim for kind of to have at least 10 weeks of buffer between when you want the cash in bank and when you meet that fund who actually invests in you. So you've also got to take into account the time period it will take to meet that fund who does decide to kind of to back you. And I would expect to meet kind of probably lots of different funds during the process. So you've kind of got to add on that time period as well to the then 10 weeks it would take when you do meet the fund who chooses to back you.
Cool. Ryan?
Yeah, I don't disagree with all that. I guess, Freddie, we normally say about 3 months. It can be done slightly quicker, but it probably takes on average about 3 months. And if you are a management team who's looking for the right solution, you will have been thinking about that probably 3 months before that, if not longer, before that as well. So these things are often driven by the financial model, or alongside the kind of overall strategy, and trying to map that out as best you can. And I would certainly be, if I'm putting my model together with my team and seeing a cash shortfall or a funding requirement within 3 months' time, that probably feels a little bit too late. We're going to have to run pretty quick, and that doesn't put you in a great position, and could almost kind of feel a little bit increase the nervousness from a lender or an investor if somebody's left it that late. So try and be getting on the front foot with these things. And if you can see out 6 months, 9 months, great. If you're asking to go out 12 months, 15 months, that's pretty hard. We're not all kind of got crystal balls. But if you can get in that 6 months, 9 months, any longer, even better, I would say.
Cool. And I guess you've both touched on this a tiny bit, but when you're talking to founders and management teams, what makes that an attractive proposition? Are there any practical tips that you can give of things that they should be doing, how they can make themselves more attractive when they're going out talking to funders? I maybe touched on it there in terms of, they say that you make it, it takes 7 seconds to kind of form an opinion of somebody. And if someone, jumps on a call and says we need X by next week, it's not a great start off to a kind of a relationship of, investor, borrower and potential client. But I think from a management team, if they've got clarity of their proposition, clarity of their journey, they're very honest with you, i.e. they can not just that they're telling you the truth, but they can identify gaps in, with the team. They can identify gaps in maybe their strategy and what they're doing to mitigate those. They're an innovative team and they are thorough, so they've covered everything off when they first come and meet with you. That's a really good start from a management team. I think from a financial perspective, I always talk about momentum. Everyone's got a good story about a great deal that they did, or a letter of intent that they've got, or we did this deal back in the day, or whatever that might be. If you can see momentum in a business, you can almost feel it when you're on the premises. Another deal's coming in. We're talking to these guys. Oh, that one's landed. So, from a financial point of view, obviously the better the numbers, great. But if you can really feel that momentum, that's important for us all, I think.
And in turn, alongside the financials, high gross margin, high growth figures, historic and forecasts are always going to appeal to especially Freddie, but our investors and our funders as well. And then from a product point of view, we love the disruptive nature. We love the kind of clear USPs. If that's protected in any way, even better. So if you come with all those things and you're ticking all those boxes, that's a really good start, I would say.
Yeah, I mean, I think there's what I would say would overlap, I think, a lot with what Ryan said, but our investment process is structured into kind of 6 key bits. There's basically product market fit. So basically what problem is this product solving and how well does it solve it? Second bit is how defensible is that product, and basically how difficult it'd be for other people long term to copy or replicate it. The third thing is the market size, how big is the market? The fourth thing is unit economics, so basically looking at how profitable we think the business could be. And then the fifth thing is the team, and the kind of last bit is the kind of pace at which it's grown, the kind of traction to date. And we kind of structure all our thinking. They're kind of sort of in no particular order there really, but we structure our thinking around those 6 key headings and do a lot of thinking, debate, and analysis to understand kind of what the business looks like in those areas.
Yeah. And I guess sort of conversely, are there any things that you see that are sort of common mistakes or things that are an immediate no-no where people come out with things? So Ryan, you've mentioned people coming to you and saying, we need this money now. And understandably, that sends up some warning flags. But are there other things that you see that are common mistakes that people make?
It's hard to say. I mean, I think probably the biggest one that I do see kind of reasonably regularly is not it's sort of maybe speaking too much and not giving the investors to ask questions, because ultimately they need to dig a lot, and there's a lot of things they kind of want to understand, and there needs to be like that kind of they need to have the opportunity to basically ask that questions. And I've had a lot of meetings where it's kind of been one-way traffic, and it also just means you don't get a chance to understand things you need to understand for when you talk to your team about the business. So it just doesn't let the entrepreneur founder have as kind of good a chance as possible. The other kind of small thing I would say is that, and it's not sort of a mistake per se, it's an opportunity of something that can be done better. Product demos are always really compelling ways, I find, for basic kind of to show off the product and to really let it hit home kind of the problem it's solving, what the product does. And I think sometimes in first meetings, entrepreneurs often talk about stuff in kind of abstract terms of it, and actually kind of just a simple product demo can kind of speak 1,000 words, if that's the right term. But it can really be really, really helpful. And I would always encourage entrepreneurs to bring that forward as early as possible in the process. There's often, I often notice kind of step changes in the more senior people's attitudes to companies from what I've kind of described to them and kind of all the details I've showed them and how they think about it, versus then suddenly when they just get a demo and often just kind of the penny drops and it really clicks and they actually have a much more kind of positive attitude towards the company. So anyway, yeah, kind of 2 slightly random things.
Yeah, well, it's all about practical tips. So yeah, it's really helpful. I've only got a couple more questions for these guys. If the audience who are watching it do have questions, please add them into the chat to your right, and we will get to those in a bit. But I guess my next question is sort of about early stage companies, but I guess it's also about proof of credibility. So does it really matter when you're talking to businesses what incubators and accelerators and programs they've been for? Is that something that you look for? It's certainly something that early stage founders talk about a lot, and I just wonder how much credibility it really adds for them. Either of you?
So I would say at every stage, kind of the kind of brand name stuff you already have will help other investors kind of sort of can be used by the investors at a later stage to slightly filter companies. So obviously, if you've got an incubator they know of, or a seed fund that a late stage investor knows of, it may make it slightly easier to get that first meeting. And that kind of logic applies the whole way up the chain, where funders at later and later stages always look at the kind of funders you had at a previous round to make a very quick kind of snap judgment of the company. But other than that, I would say the main value from accelerators and incubators comes from what you learn there, the people they can put you in contact with, and their funding, more than the fact that you've been in a kind of incubator accelerator on its own.
Yeah. Ryan, what's your take?
Yeah, I was just saying, I think probably Freddie will see more of these than we do, with perhaps just, the stage after. But I think what I would say is it's not unusual to see the difference to what an incubator's made to a management team for those that have been in part of one. And it's things like governance and structure, identifying gaps, actually, the two key things that we always hear about in terms of access to kind of good people and access to finance are the two things that crop up a lot. As part of an incubator, it's just easier to be sharing those kind of thoughts, discussions, and therefore, you can overcome some of these issues earlier, or at least having considered them, thought about a plan which might actually, mitigate those issues and risks for you in the future. So I haven't seen a negative side of being part of an incubator. If anything, it does just kind of bolster the team a little bit.
Yeah, absolutely. And I think we see that a lot locally. I think that piece about, certainly for early stage founders, helping create communities is really important, because at the very early stage, when you're on your own or in a very small team, having a community to work with, to learn from, can be absolutely key. And we see that with lots of the incubators and accelerators that are based here. And I know Katie and her team have similar experience up in Manchester. So I guess the final question from me, and this is something where you guys probably don't actually look that often, but I guess you'll be aware of. Where are the best resources? If people are going to look for funding, or what other people are doing, where would you suggest that they go about looking?
I was going to let Freddie go, but why not? I mean, we get this a lot. We hear this quite a lot, actually, and I don't want to say I get a little bit kind of frustrated, but I see the number of I suppose guys like yourselves, guys like Manchester Tech, guys and organisations that are set up to point people and encourage people to kind of join a community where they can provide them with access to finance. And if I look at the kind of Manchester ecosystem in terms of the number or the volume of equity houses, right down to angel investors, seed investors, venture debt providers, VCT, EIS, access to kind of regional funds and things like that. There is a huge amount of capital out there. I may be a little bit blasé in that respect, and try and put yourself into the entrepreneur's shoes. But a simple Google search, I tried it when you asked the question in terms of accessing funds in the Northwest and things like that. You can find that information fairly quickly. And I think that what I found really pleasing now, compared to maybe 15 years ago, is there's a real willingness for people to try and see good management teams, good businesses get that access to capital, whether it be people, whether it be finance. And, I will pass things on to other providers where our criteria might not be met. And I've had introductions from people who you might deem our competitors, where something doesn't quite meet their criteria. Is this something that you could look at, Ryan? So I feel that there's a genuine kind of willingness for communities, certainly in the Northwest, to get that done. And I'm sure that's the same in the Southwest and beyond. So I guess if you're, from a simplest Google search to maybe speaking to your accountant, or, who do you know a decent corporate finance boutique? These guys, or even go to the local, Manchester Tech or people like that. They will be able to kind of point you in the direction of people. I'm sure.
Yeah.
Yeah, and the only other sort of source I would add to what Ryan said is just other entrepreneurs, and ideally ones who have gone through a kind of fundraising process will be incredibly knowledgeable of the different ways of getting capital at different stages. So if you can find ways to meet, if you know someone already, great. If not, if you can find ways to meet them through various networks and meetups and stuff, obviously that's kind of as good as best a source as possible, really, for kind of neutral and insightful information on that.
Yeah, and I think we've seen a lot of founders passing that information between themselves, and certainly through some of the networks here, the incubators, accelerator networks. So Set Squared is a great example locally of connecting into investors and talking about some of the things that are going on. And there's certainly a whole specific set of support for people who are part of those networks. And there's also, as a pitch to ourselves, I guess, through some of the programs that we run, part of the logic of those programs is to share where there are investors and funders looking. So there's lots of stuff we push out through social. There's a really good, a really long spreadsheet that came out a couple of weeks ago of VCs who are still investing during Corona, which I think is doing the rounds and being sent around. So there's lots of those things where, you know, it's not in-depth advice, but you can certainly get quite a long list of people who are doing things. So shall we have a look at some of the questions that people have asked us? So I'm going to jump in straight with Zara's question. So Zara, as ever, is several steps ahead of me, and I haven't actually read the Sifted article today about not bailing out early stage startups. I don't know if either of you have either. I'm assuming the questions, the tone of the article will be around, that's the whole point of startups, that there is a level of risk, and if we start putting money in to support things, is that the right thing to do? Do either of you have any views on that?
Yeah, I just had to quickly deal with it a couple of minutes ago. Very interesting question. I mean, I assume, to be honest, what that's mostly been driven by is, I mean, government intervention can just distort the market, right? And if future investors just know that in the case of like big macro crises, the things they invest in will be bailed out, it can basically create a bubble, right, where people know there's like some downside protection, and it will inflate valuations and kind of distort the market a bit, and that's not necessarily that helpful. So I assume that's kind of where he's coming from there. But yeah, very, very interesting question. Yeah.
Ryan, have you any views?
Yeah, I suppose I haven't read the article, but I think listening to the Freddie's kind of summary of it there, I suppose the question is, so what is the answer? When is the right time and wrong time, and I guess understanding the impact of that is what we can do, but we probably don't have the solutions for it. I think what I would add, and something that I have read and seen, is that it is recognised. So I think there was a post or a report done by the BVCA, I think on Friday last week or Saturday, which spoke specifically in terms of recommendations around these types of businesses and the requirement that there should be some support and they shouldn't be ignored at this stage. So don't have the answer, but I think there's some confidence there that it's been discussed at the right level with the right organisations that have got weight behind them to kind of lobby for this kind of thing.
Yeah, and I think we've seen lots of these conversations, and it's a really difficult issue because the startups that are struggling now aren't necessarily struggling because they're not a brilliant proposition. It's a global challenge that's hit them, but how government can do that without distorting the market incredibly is a really difficult thing. And I know there are lots of things that they're trying to do. A lot of the Bristol people will know one of my particular hobby horses amongst this as well is a lot of the wider support and the ecosystem that surrounds startups is something that's also really struggling. So there are lots and lots of networks and co-working spaces and incubators that don't have huge corporate parents and don't have government money, who may well not survive this. And that's something that, for us, unsurprisingly, as a tiny network, is something that's really important, because I think if we are going to come out of this, and we're going to come out of this strongly, that sort of wider ecosystem support helping startups is really important. And that's something that we, and Katie and her team, are particularly lobbying government about as well, because there's a whole ecosystem there, and you have to support the entire ecosystem if you're doing something, rather than just one particular part of it. But that's my particular hobby horse. So let's have a look at Sean's question. What advice would you give in funding allocation during this crisis? How should a startup spend it?
Good question.
So,
go on, Freddie, I'll let you go.
I'm sorry to say something, but I mean, obviously, it depends obviously massively by company. So I think, to give a kind of specific example of where the strategy and what they're spending the capital on has changed a lot. There's one company in our portfolio who essentially is going to be very unlikely to make any new sales in the next, whilst COVID is having kind of the impact it's having. And so there's obviously no point in spending any capital on sales and marketing. So they've reined that in. And what they're now thinking about is kind of working out how much to spend on product and improving the product. So thinking about when this ends, how can they improve the product, and what kind of additional products can they build, and what will be the value of them kind of post-COVID, and therefore how should they prioritize them, and how much should they invest in them, and what should they invest in and not on the product side. But I mean, they're at the extreme where there's kind of literally all sales and marketing spend would be kind of essentially pointless during this time. And there'll be kind of a lot of stuff that's actually completely fine and can carry on selling. And there'll be a lot of stuff in between. Yeah.
All I would add to that is what we've seen in, what we discuss in terms of kind of portfolios and things like that is that focus on operational gearing during this time. So what is your fixed cost base within your business versus what's your kind of variable costs and your operational costs in the business? And that is something that we've been talking at that earlier stage when we're going through the process to look whether we will invest in somebody. And they're talking about a downside scenario. What's actually been playing out over the last few weeks is exactly that. And it's been really quite interesting to see some businesses actually be able to take advantage of, furloughing staff, getting those costs covered, albeit with a slight delay. The rent and rate schemes, grants and things like that. And what you've actually seen in some instances is actually they're able to, where they've got kind of contracted revenue streams, it's a great model. It proves that kind of protection that you get in a downside, that you can actually run a business with a skeleton staff, take out all the costs, and actually bottom line could potentially improve and cash can improve. Now that shows the strength in that recurring revenue and contracted revenue base. Unfortunately, that doesn't apply to all. And I think in those instances where you do have any surplus cash after all of the incentives and scheme, it is that decision. It's that decision between, can we keep the product development moving so that we're in a good position to kind of really kind of springboard when this is over, versus do we just need that surplus cash to survive and still be there at the end? And that's, unfortunately, there'll be businesses that cover all of those scenarios.
Yeah, and I think one of the things that's becoming more apparent as time goes on with this is it is flagging some really interesting questions about how lean some of the organizations actually are, and what we are spending our money on and what we really need to spend our money on. And I think a lot of organizations have seen, office is a really easy one to pick up on, of how much space do you actually need coming back out of this? Because clearly lots of us can work from home and we can do that relatively successfully. So it'd be really interesting to see, assuming we're all still here, where we'll be in 6 months and how this does start to impact. I think that's pretty much all of our questions. Jenny and Glenn have flagged the Save Our Startups campaign, which is a campaign that the article that Zara mentioned is referencing, which is asked for 3 things. One of them is about EIS and SEIS and increasing the amount of that. It's a campaign that we've signed, and I know Manchester Digital have signed. Have a look at it, sign it. But I think that's pretty much it from us. So thank you very much to Freddie and Ryan for today.